Hi, welcome back to this mini video series where I help you build a financial spreadsheet entirely from scratch. If you haven't done so already, please go back and check out the first video in the series and work your way up from there. In this video, I'm going to be adding the volatility of cash contributions and cash withdrawals. So while it's very neat in our model up until now to have had a certain amount of money that we put into our savings or our investments every year and indeed take out every year, in reality life is more complex than that, or often is in any case. So I'm going to build in that the contributions may be very volatile, and they may be volatile in the sense that they're completely random around a certain average, or they may be volatile in the sense that they depend on the wider equity markets or the state of the world around us. We do this both in contributions and in withdrawals. My name is Lars Kroyer. I'm a former hedge fund manager who has written a couple of books about finance, and I'm now doing these videos as a hobby. I'm not a financial advisor, so before you do anything I say in this or in any other video, please do your own work, do your own analysis. But let's get back to the spreadsheet. So here we are back at the model, and just like in every other video, I'm going to start by creating a copy of the previous model. There we go, and in this case we're going to call it very I want to say very cash flows. That's probably more cash in outflows. That's perhaps, oh, you can't do that. Cash in and outflows like that. There you go. That's a little messy, but there you go. All right, so now what I want to do is I want to make these contribution vary. I want to start by perhaps creating a little bit more space up here, and then I want to create let's move this down here, and let's say call this one contribution, and this one spending or withdrawal. We can call it whatever we want. Now, let's go home, let's write a line and underline these guys. And now, let's call it expected annual cash flow. And then let's call it expected growth. So the 3% is still the same. Now, let's take the 4,000, put it up here. Let's take then, and then we can make this equal to that instead, and make this no longer blue but black. It's automatic. And take the 10,000 up here, like that, and make this equal. We'll probably have to change that later. And now we no longer have these in the model, but up here we should probably do an expected growth also for the withdrawal. You can change these as you wish. But what I wanted to introduce is risk to these cash flows. So let's just call it standard deviation. Deviation, and we can do some pretty big numbers here to start with. Then what I want to do is move out here to the right in the model. And what I want to do, I think it gets a little tricky, but now what I want to do is have the base. So this is like assuming no volatility. So base is therefore the 4,000 in the first year. We should make it. This is a big point, but this section really is for this beginning of year. Note this section is based on start of year of the year. Okay, so base is this, and then we will grow this by the growth rate. Oops, 1 plus the growth rate, which is here. Let's just for now ignore let's for now ignore the contribution like that. And so this is gonna always be in 16. So now we can copy this down. Now what we can do is with the random impact, let's just for argument's sake, so let's say with random impact, let's put it up here, with random impact. So this is where let's just for argument's sake say that the first year is always going to be the same, because you're sort of contributing the first year, so there's no risk around that. In other words, this model doesn't really start until you contribute it. Now, but in the next year, let's copy this cell down. Now we're going back to the normal distribution function that we had in the past. Let's make a little bit more room. Normal, this was the inverse, remember? And then we do the random number, which is the zero between 0 and 1. The mean now is going to be this number. So this is basically the number where if there's no risk to our contributions, we're saying in this case we contribute 4,000 and we grow that by 3% a year. But now we're introducing, so that's on the mean in our outcome, or the average. Now we're introducing the standard deviation. Now the standard deviation is the one we put over here, in this case 200%, but it's times this number, times T26, so that should work. So this is going to change every time, and E17 should always be E17. So here we have it. So now we have our contribution as it changes every year. We can copy this number down, we can recalculate it, and what you'll see is that it changes every year, or it changes every time we recalculate it. Again, I really should create a different model or a different spreadsheet, because now it takes pretty long to calculate. I'll try to do that in the next video. And then we can copy this down. So what you see, it slows down the functioning of this model. The computer is still calculating these cells and not allowing me to move on, which is really quite frustrating, actually. And as the model gets bigger and bigger, that will happen more and more. So, but we can copy this down. So basically, I'm not going to recalculate very much in this model. And then we copy this down, and you can see now we need to move it. The same thing with our withdrawals. So let's just say that the withdrawal is no longer the first withdrawal is going to be this one, and then this case the withdrawal. This is right. We can't have a negative number here, because it's going to be, can't do a negative standard deviation. So we need to do an absolute ABS of this number, but also it shouldn't be E17, because you can see this is highlighted. It should be F17. F17 is now, so basically what we're saying here is that with the random impact, and these numbers might seem like Chinese to you, unless you are Chinese watching this, of course. But what we're really saying here is that there's a fair bit of standard deviation around your withdrawal of money, which kind of makes sense, right? So now what we need to do is this is equal to the base is that times 1 plus this growth rate, 2%. There's no reason that we can't make that similar to the other one, to the contribution growth rate, and that again should be 16. So now, there we have it. So now we've calculated it down, and we see that the contributions with the random impact and the spending of withdrawal with the random impact really changes quite dramatically. What we need to do now is to put this number back into the model. So this number, and keep in mind these numbers out here are beginning of year numbers. But I want to do one other thing before I do that, and this is where it gets a little bit tricky. So now what we've said in the model is essentially, life is random, or contributions are random. They may be stable every year, but they can vary quite a bit, and we can just change these standard deviations if we think the the standard deviations are unfair or too big for how big our contributions are. One thing that's really worth noting, by the way, is that the higher the standard deviation, the more cases we'll have where our contributions will be negative, where even without having money, we will be withdrawing money. I will have a deficit. It is actually a flaw in this model. Now think of it that we would have essentially assumed that your borrowing rate would equal to market equity returns or whatever your asset allocation mix is. So that's probably it's quite unlikely really in the model, but I want to make a note of it. So note, so call it small flaw of model. Some people might say this is a big flaw. If you go below zero, model assumes you can borrow at equity returns, at equity, asset returns, which you probably couldn't. Is unlikely. Let's call it. There you go. So just so you can see, this is seemed like a lot of gobbledygook to have in there, but at least I want to have that in there. Now what I want to do is I want to introduce with market impact. So what this is saying, well, not only is there a random element to how much money you're able to contribute, but there's also an impact of the world around you. So the better the world around you is, the more likely you can contribute. The worse the world around you is, the less money you can contribute. That seems fair enough. So let's call it with market impact. Now what I want to start here is, let's start with the base. So you can say, what is the base if there was no, now what do you expect the world to grow at? So call it base. And here we should do the average. And since this is the start of the year, we can frankly just start with, let's call it 1. And then with actual market impact. So this is with the random, with actual, let's copy this up, with actual market. Now again, because we're starting, this is the start of the year, we're gonna let's just make these pretty, copy them down so we don't have to, but then these should be really, I mean, just like this should actually be blue because it's sort of a standout number, I guess. It's a number we want to notice in our model. Now, so the base is, the expected is going to be this times 1 plus the compounding rate in this case. So this is how much we expect the 1 plus the compounding rate. And then what was it in reality is therefore this times 1 plus, and then you got to do prior year, right? Because this is the numbers out here at the beginning of the year. Now to copy this down, we need to make this constant. So now we copy this down, and then what we say. Oh, by the way, we can do something kind of interesting here. If we want to see in this model run, we can say average return. Let's do that here, average. We can simply say this would allow you to see the how lucky, unlucky you are in this specific case instance of the model. So, for example, here we see that the average in this run, we make this bold, was at 3%. Which is, basically this random instant was 3%, where we would expect an average of 7.45% in this instance. We can just do the same with KGARs, which out here we can say, well, in this instance, you can see this was a really unlucky instance. Let's copy this out, and we can do the KGAR here, CAGR, and here that KGAR would be, let's think about this. It would basically be equal to this divided by this to the power of this. I appreciate this is probably fairly complex for people that are not used to this math. So -1, is that right? 4 So basically this is saying that the CAGR we experienced in this run of the model was 4.5%, which actually was very, very close to the mean. If we run this again, we would get a different number, which also you can see here the base and the actual. So basically once we introduce chance into the model, it's actually very close in this instance to the base. So what I want to show you here is, so how did you do in this instance relative to the expected? This is important, right? So how did you do relative to expected? And in this case, it's going to be basically how lucky or unlucky we're. Let's make that a percent, actually. So you do, let's use this one so we don't. So in this instant, you say, by the way, you can see how all these numbers change as I'm working through the model. That's a bit silly of me. I should have it on only recalc once in a while. But let's do this. So say we say, how did the actual divided by what we had expected if we were compounding, and then -1. So let's see. So here we did 15% better. There we did the same. And then let's copy this down. So this is interesting, right? Because now what we're seeing is every case, and this is a terrible run in the model where we had a very, very bad CAGR. So this is essentially saying, well, if this state of the world happened, we would end up with far, far less money than frankly we had expected, because, you know, instead of the market going up at a CAGR of 4.5%, in this instance, the model, it went down by 0.5%, on average return of 2.5 as opposed to 7.45. So this was a horrible state of the world. So what we're trying to say, well, you know, we expect that we can contribute some 4,000 a year, growing by 3%. There's a bit of randomness around that. But what we then want to say is, well, the market also impacted that randomness, right? So that's what I want to capture in this model. And I think this is actually, I know this is a little complex, but I think, you know, we want to have this in there because we want to say, well, how susceptible are your contributions or your withdrawal to market rates? So that's something we need to have in there. So market impact on cash flows. And let's make this, let's say this should not really be an X. So what we can do is format cells. Let's make this an X. So the multiple we have custom. So 1.00 X like that. Does that work? So this is basically saying, let's say 1. So whatever the market did, and let's in this instance say minus. Let's just make it 0. In the case of spending, that there's no market impact on our spending. Okay, so now this is where I think this kind of model gets really, really interesting. Is now we're saying, let's say that with the market impacts, in this case, if you look at the number out here, in this case it was 8% better than expected. So that means we got this 16,800 in this case with essentially saying that's just what we expected with some randomness around it. Plus, we then got the same contribution was impacted by our market impact. That's this number. And then the number up here is saying, well, how susceptible were we to the market impact? In this case, let's say 1. So just to go through this formula. So U26 is saying that's what it was, our contribution with randomness around it. Y26 in this case was saying, well, how did the market behave? Did it do better or worse than we had expected? And keep in mind, we had expected it to go up with 4.5% a year. And then E18 is what is our personal impact on these market contributions. So in this case, we're saying, well, if markets do 50% better than expected, well, on all else equal, we will be able to contribute 50% more than we otherwise would be. That's what this formula is saying. That's kind of neat, I think. So so let's make E18 a constant, and then copy that down. There we go. Now, then what we should do is when we get to the withdrawal, it should no longer be E18, but F18, because we might have different impact of the market once we, which I think is quite likely, right? In old age, you are less likely to have the market impact your spending pattern. It'll probably be issues like health. But again, we can change that. By the way, keep in mind when it's withdrawal, the spending number should be a negative number. Maybe we should, for spending, I think that's worth noting actually. For spending, remember negative sign. So basically, what you see here is that the markets go up. And you want to make sure you get that sign right? Because now you're taking money out, and instead of saying, well, I need less or more money out when the markets go up or down, it's opposite of the contribution, right? But let's make it 0 for now. We can even make this 2 for now. Now, so net. So here we are. Now we've built this into the model. It's a fairly complex thing to build in, but I hope you understand and appreciate why this is important. We've essentially made this more complex, but also, I think, more real life. Now, the final thing is to incorporate it into the model. The reason this is important, so this is now equal to the number out here. Boom. So what we see now is we've incorporated into the model over here. So the annual contributions in here now depend on these numbers out here, which should depend on V. Let's just double check I did that right. Otherwise, please tell me in the comment section as I'm getting things wrong here. Now we have it, right? So V, that was right. What we've incorporated in this model is randomness of your contribution, randomness of your spending pattern, which I think that's life. Then what we said is, how susceptible are you on top of that randomness in its own right? How susceptible are you to changes in how the market is doing? So if market goes up, you'll probably be able to contribute more money. That's kind of something that makes sense, I think, right? Because the world is a better place than we expected it to be. If the world is a worse place than we expected it to be, you'll be able to contribute less money. That makes sense. You can play around with these numbers and make them suit your particular situation better if you want. But I think we're now beginning to accomplish a model. It may look complex, but we've gotten a model to a point where you say, well, yeah, maybe this actually kind of resembles how it would be in real life. There's a market, there's an allocation, there's risk around the market. Then there's also, again, we haven't included the tax and trading costs, but we're also taking expected return down, so maybe that's somehow in the trading cost, so you can call it that. But then also our contribution and spending pattern, we've said, well, we expect it to be a certain amount, but we also appreciate there's a lot of randomness around how much we'll actually be able to contribute or need to spend, and then also that there is an impact of the market on our spending and contribution. So now I think we're getting to the point where the model accomplishes a fair bit. Now we can recalculate it, and hopefully it doesn't go up in smoke. And what we'll see is that we've actually increased the volatility, right? The volatility is gone up because now it's not just the market that's volatile, it's also our own contribution. So if we are able to contribute less because markets are bad, we will have less, not just because of our savings are worth less, but also because we contributed less. So it's a double whammy. This is very important. Actually, what's kind of interesting here is you're beginning to see, once this beast is done recalculating, which it's not yet, you'll begin to see that these numbers are just far more volatile. But I'll stop there, and in the next video, this will actually take a little while to recalculate. In the next video, we will we'll go in greater detail into what all these numbers mean. So guys, as I did after adding fees video, it was actually, I realized the mistake. I should have made the 90th percentile into 10%. I only realized it after I had recorded both the adding fee and the various cash in and outflows sheet. So I'm just going to make that correction also here. This should be 90%. So that we see the best 10%. I realized that after seeing that the best 10% and the worst 5% were all too similar. But now it should be corrected. So sorry about that. And now it should be up to date. So thanks for watching. I know that was a lot to take in. I hope in any case that was interesting and useful. You can subscribe to my channel if you want to hear about the next installment in the series. But in any case, I hope to see you in a future video.